Hello everyone. Welcome to Demand Supply Trading Practical session number 46 for the year 2025. Myself Srijit Kakkar, and today is Sunday 30th of November 2025. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you with content related to demand supply trading methodology. Plus, when these live sessions are scheduled, we also update you regarding this so that you can take out time and you can join the sessions live, because there are few advantages of joining the session live. We'll talk about it as we move forward. Now, to join this channel, there are a few different ways. The first one is you can scan the QR code which is on your screen. Second, if you go to the description of this video, you'll be able to find the direct link. You can click on that link and you can join the Telegram channel. And the last option is when you visit our website, which is surjitkakkar.com, or you can use the short URL, which is sk.coach. So once you're on our website, I'll just quickly show you. You can just scroll down on any of the pages, and in the footer section, you have this banner which says join the Telegram channel, and in front of it, you can see you have the join now button, and you can click on this join now button to be part of the Telegram channel. All right, so okay, let's get back. Perfect. So today's session is practical application of demand supply trading methodology. So our demand supply course is now available as a 100% free course. Now, how do you access the course? We'll talk about it as we move forward. But once you go through the course, you basically learn the methodology theoretically. What is demand supply, how to identify zones, how to qualify zones. But what happens is, unless and until you see some practical examples, at times you don't get a very good understanding of how the methodology has to be implemented. So that is what we do in these live practical sessions. So almost every weekend, I do a practical session where we take some examples, and to those examples, we apply the complete process so that you can understand how to plan trades very mechanically and rule-based. So like I was just talking about, there are few advantages. Let's talk about what are the advantages of these live sessions. The first one is, because it is a live session, if you have any challenges, questions, queries related to trading or with demand supply trading methodology, you can always put it in the chat box, and excuse me, and at the end of the session, I will be taking your questions, queries. So again, whatever questions, queries you're putting up in the chat box, I'll not be taking it during the session. At the end of the session, we'll definitely look into it after we are done with the analysis. And the second advantage is that during these sessions, you will see that I'm not analyzing something which has already happened, because I always say that a move which has already happened, it's very easy to justify it. You can use a number of indicators, a number of oscillators, even price action to justify why you could have participated or you could have avoided that particular trade. But the real beauty is when you have to do the analysis in advance, and that is what we do in these sessions. We are not looking into things which have already happened. We are looking into what might happen in the future. And that is how we plan our trades. And that's the beauty of demand supply trading methodology, that you can pre-plan the areas where you would like to be buyers and sellers. And eventually when the prices, they revisit those areas of demand and supply, that is the time those trades, they get triggered. So again, we are doing the analysis in advance. And just because I'm doing the analysis in advance does not mean that I share the analysis with you and then we forget about it. Whatever analysis I share with you, whenever they get triggered in the future, we also review them. And the reason behind that is because when we review them, then you are able to see both the before as well as the after, because we did the analysis in advance. And then you're also able to see when the prices, they came into the zone, how did they react to the zone. And that eventually helps you build up confidence in the methodology, which is very, very important, because if you don't have confidence in a process, why would you waste your time learning it, right? Only when you have that confidence, you will put in that effort and you will put in that time to learn that process and maybe make it as part of your trade plan, or maybe that methodology itself might become as your trade plan. So again, the advantages of practical session, you get to see the before as well as the after, and nothing can be more transparent than this. And plus, you also have the opportunity that if you have any doubts, questions, queries related to demand supply trading methodology or related to trading in general, you can always put it in the chat box and I'll answer your questions, queries at the end of the session. All right, now to be comfortable with these sessions, there are some prerequisites, because if you don't complete these prerequisites, you might not be understanding the concepts, the terminology I might be using. So to have a good understanding of what we are doing and why we are doing that, there are some prerequisites which you should be going through. So let's talk about what these prerequisites are. So the first one is your Trading Essentials course. Now, the reason it says optional is because someone who already has a very good trading background, if they wish to skip it, they can. But I would generally advise that irrespective what your trading background might be, always start with the Trading Essentials course. Now, how do you access the Trading Essentials course? Let's talk about it. Give me a second. So to access the Trading Essentials course, what you need to do is visit our website, and you can see under services, we have this option which says courses. So click on courses, and you will be able to find Trading Essentials as the very first course. Click on this. Now, once you're on the Trading Essentials course page, you can see you can start the course in two languages, English and Hindi. So whatever language you're comfortable with, click on that button and you will get immediate access to the course content. No signups required, no registration required. So just go through the complete course content, which is a few lessons. So go through each and every lesson. And once you have completed all the lessons, that basically covers your Trading Essentials course. Now, once you are done with the Trading Essentials course, you will move on to the next step, which is Demand Supply Trading course, because now you also need to learn demand supply methodology. So how do you get access to it? Same process. Under services, go to courses, and you can see the next one is the Demand Supply Trading course. Click on it. Now, this is also available in two languages, English and Hindi. So whatever language you're comfortable with, click on that. You'll again get immediate access to the course content. No signups required, no registration required. But once you go through the course, you will be learning the methodology theoretically. And what happens is, unless and until you look into some practical examples, at times you don't get a very good understanding of how that theory has to be applied. So that is why you can also access the practical sessions. So when you click on practical sessions, you can access the recordings of the previous sessions. So all these practical sessions that I take every weekend, they are recorded and archived for you. And currently the archive is almost close to 2 years of recordings. So you have a lot of content available to you. And the practical sessions are also available in two languages, English and Hindi. So whatever language you're comfortable with, you can watch the recordings of the past sessions. Plus, like I already said, I do these practical sessions almost every other weekend where you can also join in live. And if you have any questions, queries, you can definitely put it in the chat box and I'll help you with your questions, queries at the end of the session. All right, so that covers the first two prerequisites. The next one is your rule book and followed by the flow chart. Now, these are two documents which we use to plan trades in a very mechanical and rule-based way. You can also call it as your trade plan. Now, how do you access these two documents? Very simple. Again, when you visit our website, under services, you have the option for downloads. Click on this. And here you can see you have your rule book and the flow charts. You can download the rule book and the flow chart. So this is your rule book and this is your flow chart. So now the question is, how do we use these two documents? You will experience it during the practical session, right? So today when we do the analysis, I will be going through these documents and I'll be applying everything available in these two documents in a very mechanical and rule-based way. So you will be able to understand how these documents have to be used. All right, now before we start with our analysis for today, we do have one trade from the past which got triggered during the week. So we will start with the review of it, and after reviewing it, then we'll start with our analysis for today. So just give me a second, let me bring that up. So this is the example which got triggered during the week. So this is from session number 40. We did the analysis on the 19th of October. And the prices came into the zone on the 24th of November. So you can see this is the day when the prices came into the zone. And when we did the analysis, the chart would be something like this, right? So we did the analysis, chart was something like this. And then you can see we came into the zone. Now at the time of arrival, we will be checking how's my reward to risk ratio, because we understand that not every trade will be a profitable trade. So we only want to take trades where at least we have a 2:1 reward to risk ratio. And for targets, we don't use quality areas. Targets can be any demand supply structure. So if I click on all demand supply structures, you can see we have an opposing zone, which is right here, a drop based drop, but it was already tested. So the fact is, if I'm looking for a fresh area is pretty far away, which is basically showing me a reward to risk ratio that is approximately, this is 4:1, then this would be 5:1, 6:1, maybe about 8:1, right? So the reward to risk ratio is not a challenge. We can see about an 8:1 reward to risk ratio on this particular setup, so which makes it as a valid setup for us based on reward to risk ratio. But when we did the analysis, this was a type 2 or a type 3 trade for us. Now, how do we take type 2, type 3 trades? Very simple. For type 2, type 3 trades, we wait for the prices to enter inside of the zone. Once the prices have entered the zone, then we will wait for a bullish or a very bullish candle, again, depending upon your personality style, depending upon your trade plan. If you are a very conservative trader, you might say, I only need a very bullish candle, which will be my signal for a type 2 or a type 3 trade. If you are not a very aggressive trader, right, you want to be a little on the conservative side, you might say, I only require a very bullish candle, right? Otherwise, you might be happy with a very bullish or even a bullish candle. So what we need to do is we need to wait for that signal on the refining time frame. And as a monthly income trader, our refining time frame is the 60 minutes chart. So once the prices entered the zone, you would have gone to your 60 minutes chart, and then you would be waiting for a bullish or a very bullish candle based on your trade plan, based on your personality style. So let's assume you were waiting for a very bullish candle. So this candle is not very bullish, this is not very bullish, this is not very bullish. So all these candles which I'm crossing, none of them are very bullish candles. So this was the very first candle which was a very bullish candle after the prices entered the zone. So as a type 2, type 3 trader, at the completion of this candle, this was a signal for you that yes, now if you want to take a type 2 or a type 3 trade, you can go for a type 2, type 3 trade. So this was the last candle for the day. So probably you could have entered almost at the end of the day, or you could have entered at the starting of the next day, right? That is where your very bullish candle was. So as a type 2, type 3 trader, you would have got an entry which would have been a little deeper into the zone instead of buying at the proximal line, because now you're getting a better price. But if you are a type 3 trader, then what happens is you wait for the prices to leave the zone, and that is the time you enter the trade. So as a type 2 trader, you would have got your entry somewhere around here. And as a type 3 trader, when prices they left the zone, which is on this particular candle, as a type 3 trader and as a type 2 trader, you would have got your fill somewhere around here. So again, yes, irrespective whether you were doing it as a type 2 trade or a type 3 trade, you definitely had the opportunity to participate in this particular trade. As of now, we are again back into the zone. So we'll have to wait and watch how this trade plays out. But yes, as a type 2, type 3 trader, we would have got the opportunity to participate because the zone has not been violated. You can see we definitely went pretty deep into the zone, but the zone is still holding. And we will carry this forward and see eventually how this one plays out. So that takes care of the only trade which got triggered during the week. And now that we are done with the review of it, just give me a second. Let me bring up the chart that we will be analyzing today. Now, today's example is pretty unique. And this is something I always keep saying, that when we learn something theoretically, whatever we are looking into are textbook examples, but when we get into the practical application, every chart can be a little bit different, and there can be some conditions which you can see. I have been taking these sessions for almost 2 years now, and I guess this is the very first time we are taking such kind of an example, right? We already have the rule in the rule book, but we haven't covered an example where that rule was applicable. So at times, even finding such an opportunity might take us almost 2 years. So that is the reason I always keep telling you that try to go through as many practical sessions as possible, because the more number of practical sessions you will see, the more variety of trades you will be able to see, and you will learn how to handle such situations when you're doing your own analysis. All right, so let's get started with today's analysis. So first and foremost, whenever we talk about trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video, and the title of that video is How to Start Trading. In case you have still not watched that video, the link is available in the description. Make sure you watch that video, understand the process. Everyone will have to go through that process. The sooner you start, the better it is going to be for you, because the biggest challenge which everyone faces is how to remove emotions from my trades, right? And that process basically helps you practice how to remove emotions. Yes, it might not happen immediately, but that is the only way to practice how to remove emotions from your trades and start planning trades in a very mechanical and rule-based way. So again, because we need to be mechanical and rule-based, what we need to do is we need to create something which is called as a trade plan. Now, when you're learning trading or when you're learning a new methodology, it's not very easy to create a trade plan from day one. The reason is, to create a trade plan, you need to have a good enough understanding of that particular methodology. And once you have good enough understanding, then yes, probably you can convert it into a very mechanical and rule-based system. So to overcome this challenge, what I've done is I have created a ready-made trade plan for you, which is a combination of two documents. Like I already said, the first one is the rule book. The next one is your trade plan steps. You can also call this as the flow chart or the walkthrough, which guides us what we need to do as a demand supply trader step by step. Now, all these steps, they have their own elaborate rules, which are available in the rule book. And mind it, this rule book that I've shared with you is a conservative approach, because whenever we are learning something new, it definitely makes sense to start with a conservative approach. As you start having more and more experience, you start building up confidence in your analysis. You can always modify it to better suit with your personality style. From conservative, you can make it aggressive. You can make it super aggressive. From conservative, maybe you can even make it super conservative. So every trader has a different personality style. So based on that, you can definitely tweak the rules to make it more in sync with your way of trading, but at least you do have a starting point using which you can start planning your trades very mechanically and rule based. So what is my step number one whenever we start planning our trade? Our step one is to define our trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why am I starting with my trade purpose as my very first step? And the reason we are doing this is because when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? And to overcome this challenge, again, we do not start by randomly selecting any time frame. We go with a very logical approach. And that logical approach is that the longer I want to be in a trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, by definition, I said daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, so let's say if I take the example of NSE India, which is not a 24-hour market. So those of you who trade this market, you would have definitely experienced that whenever the market opens, some symbols they gap up and some symbols they gap down. Now, because of this gap up, gap down, what can happen is that if you get a gap in your favor, you might get profit which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that holding a position overnight in a market that is not a 24-hour market, we have that added gap risk which cannot be avoided. So that is why my recommendation to all of you is that initially your hourlies and dailies will be done strictly as intraday trades. We don't want to keep these trades as overnight trades and take that unnecessary overnight gap risk. Now, when it comes to weeklies and monthlies, anyhow, we are not anticipating to get the exit the same day. Here, we definitely understand that these positions can last for a few weeks or maybe even few months. So we'll have no choice but to keep these positions as overnight positions. But that does not mean that for weekly, monthlies, we cannot have a gap against us. It can still happen. But because since we are leaning against some bigger time frames, the probability definitely reduces. But as you start having more and more experience, you start building up confidence in your analysis. If you want to include daily incomes into overnight trades, that can definitely be done. So again, step one, I need to define my trade purpose, and let's assume I opted, I want to plan monthly income trades. Now, once I have selected my purpose of trade, now what will happen is from the rule book, I'll get to know what time frames I should be using. So if I go to rulebook page number 28, we start with the topic, which is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. Now, what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the high time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify our areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2, type 3 entries, or in case we need to apply some additional rules, we can also use the refining time frame for those additional rules. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Now in this example, I want to plan monthly income trades. So now I know as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate, used for trend analysis. Lower time frame is daily. That is where we get our SCTS from. SCTS stands for stop loss, entry target, and size. And in case we need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine-tuning the zone, type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Now, mind it, this table, which is on page number 31, is specifically for the NSE market because this market is open for about 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, like your commodities, forex, cryptos, or maybe some international markets, then you can look into the table which is on page number 32. But since I'll be taking the examples from the NSE, I will be referring to this table. So as soon as I'm done with my step number 1, now I have the clarity to what time frames I'll be using. Plus, I also know the purpose of each and every time frame. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but again, if I take the example of NSE, on NSE, we have over 2000 companies listed. So humanly not possible that every day I sit and analyze 2000 companies to identify my trading opportunities. So what we need to do now is we need to have a process in place which can help me get a smaller list of symbols. So we need to select some particular scripts where I will be doing my analysis to identify whether they are tradable opportunities or there are no tradable opportunities available. Now, how do we get that smaller list? For this, we use certain computer programs which are called as scanners or screeners. So if you'll do a Google search, you'll be able to find n number of scanners, n number of screeners, which are 100% free. But the challenge is that none of those scanner screeners are based on demand supply trading methodology. They are either based on conventional technical analysis or they are based on fundamental analysis. But that doesn't mean you can't use them, you can still use them. But again, the more your process of shortlisting the symbols are in sync with your trading process, the higher is the probability that you might be able to find something which is a tradable opportunity in sync with your trade plan by going through a smaller list of symbols, right? Otherwise, you might have to go through a bigger list of symbols. So how do we scan based on demand and supply if you wish to? So for that, I have created 2 custom built indicators on TradingView or custom built scanners on TradingView. One is called as the demand supply zone alerts and the other one is called as the demand supply zone screener. Now, if you want to understand more about them in depth, you can definitely click on this. It will take you to the product page, which is where the walkthrough videos are available. You can watch those walkthrough videos to understand them better. I'll quickly show you how you can also reach from our website. So once you're on our website, under services, you have TradingView indicators. And here you can see you have alerts and screeners. Simply click on subscribe now. It will take you to the product page, and that is where the walkthrough videos are available. But what I'll do is I'll briefly explain you what these indicators they do so that you have a brief understanding of it. But yes, if you want to go more in depth, you can definitely watch the walkthrough videos that are available. So starting with alerts. So what alerts basically do is, see, first thing you have to remember is that alerts only work during the live market. And as of now, only the crypto market is live. So you can see I just got an alert. So let's start with this example itself. So as of now, only the crypto market is live. So that is why I'll only be able to show you the examples from crypto. And what alerts basically do is, you can see that in alerts, I have given a list of about 20 symbols. And currently I'm on the 5-minute chart. So I'm telling the alerts system or the alerts indicator that out of these 20 symbols, on whichever symbol during the live market, I have a formation of a demand area or a supply area, inform me, right? Let me know. And that is what happened. You can see we just got an alert. Now, somebody who has a free TradingView account, on a free TradingView account, you can't place alerts on your indicators. So what will happen is, if you have a free account, you will get those updates as a table on your chart, like you can see here. And the same thing is sent out as an alert if you have a paid account, right? So in a paid account, you'll get these notifications as well, but in a free account, it will only update on the chart. So just as an example, if I go to ETH USD, let's go to crypto. And you can see it is telling me we have a rally-based rally structure. You can see as soon as this rally-based rally was formed, we immediately got the notification. And similarly, the other one is ETH-BTC. If I go to ETH-BTC, here also you will see that will have a, oops, I changed. This I had to change. ETH-BTC. So here also you can see we have this drop-based rally structure, and as soon as this drop-based rally was formed, we immediately got the update for it. So this is how the alerts, they basically work, that during the live market, as in when you have formation of demand areas and supply areas, you get updated. Now, how do you get updated depends upon your account type with TradingView. If you have a free account, it will be updated as a table. If you have a paid account, it will be updated as a table. Plus, you can also place your alerts where you will get these notifications as soon as you have formation of demand and supply areas. So that's your alerts. Now let me show you screener. So how does screener basically work? Now for the screener, the market does not have to be live. Screener also works even on the closed market. But the difference between the two is that alerts is helping you identify symbols where you have formation of demand and supply areas during the live market. But what screener does is, in the screener also you'll give your list of symbols. Like here you can see you can give a list of up to 15 symbols. Now once I've given my list of symbols, I also have to give my proximity setting. You can see I've given my proximity setting as 2%. So what I'm telling this screener is that out of this list of symbols, on whichever symbol the current candle is within 2% to a demand area or a supply area, shortlist that symbol for me. Now just take it as an example. If I was doing the analysis manually and if I was going through these 15 symbols, I would be wasting so much time going through all the symbols. Maybe I was closer to some demand areas, or maybe I was closer to some supply areas only on very few symbols. Like in this case, you can see out of this 15 symbols, there is only one symbol where I'm closer to the demand. So you can see we have proximity to demand, which is ABB. So if I go to ABB here, you will see that the current candle will be close to a demand area. That is what you can see here. We have this drop-based rally. We are closer to that demand. And that is what your screener basically does. It will help you identify symbols where you are getting closer to these demand and supply areas, so that you don't have to go through all the symbols. Now in this example, you can see otherwise if I was doing it manually, I had to go through all the 15 symbols. But now I can skip the rest of the 14. I know these are the only symbols where I'm closer to demand areas or closer to supply areas. And again, if you want to check it on a different time frame, it's as easy as just changing the time frame. If I change it to weekly, now you can see it is giving me results based on weekly. On weekly, we are not close to any of the demand and supply areas. If I want to check it based on the 4 hours, I'll simply go to the 4 hours chart, and now it will give me the results based on the 4 hours chart. You can see these are the symbols where I'm closer to demand, and these are the symbols where I'm also closer to supply. So just as an example, if I go to TCS, you will see we will have proximity to both demand zone as well as the supply zone, right? So that is how this screener basically works. It helps you identify symbols where we are getting closer to the areas of demand and supply. Perfect. So the good news is that during the explanation, you have seen both of them, how they basically work. So now we can focus on our analysis. Give me a second. Let's move forward. Perfect. So again, step 2 is to identify symbols for you. How you want to identify symbols, that's completely your choice. If you want to do it based on demand and supply zones, we do have these two indicators available to you. The process can also be as simple as I need a small list. Maybe I just want to analyze my Nifty 50 stocks, or maybe I have my own favorite list of symbols which I want to analyze. So choice is yours, how you want to get that list, but you need to have a list on which you will be doing your analysis. So find your list, but always remember, irrespective what scanner or screener you're using, whatever list you get from those scanner screeners, you can never blindly buy those stocks or buy those or sell those symbols, right? So whatever list you get from these scanners, They can never be blindly bought or sold. Scanner screeners, they do not tell you what you need to buy or sell. They only help you find a smaller list, which has a higher probability of being in sync with your trade plan. Once you have that list, you will have to manually analyze them and check which one matches with your trade plan. The one that will match with your trade plan might be an opportunity for you, and the one which doesn't match with your trade plan, that definitely has to be skipped. So let's assume we got a list, and in that list, the very first one was ABC. So what we need to do now is on ABC, we need to go to the lower time frame. So the question is, what is my lower time frame? We got the answer from our step number 1, that as a monthly income trader, my lower time frame is daily. So on ABC, we'll go to the daily chart, and on the daily chart, we need to identify a zone. And by zone, we mean any of these 4 structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. Now, I do understand that when we start learning demand-supply methodology, it is very challenging initially to identify where are the areas of demand and supply. But let's say even if you have a lot of experience, if you have an indicator which does the process automatically for you, the analysis becomes really, really fast and also much more mechanical for us, because now we are not identifying zones based on the emotions. We are identifying zones based on a very mechanical process, which is already incorporated into the indicator. So we do have an indicator on TradingView, which is called as the demand supply zone indicator. And what this indicator does is that once you apply it on the chart, it will automatically identify and plot these demand and supply areas for you. And we do offer a 100% free 7-day trial of this indicator. Now, in case you have still not taken the trial, how can you take the trial of the indicator? Very simple. What you need to do is when you visit our website, under services, go to TradingView indicators, and here you can see the first one is the demand supply zone indicator. Click on it. Now, once you click on it, you will get this button which says 7 days free trial. Click on 7 days free trial. And then you have this very short form. All you need to do is provide your full name, your email address, and your TradingView username. Now, very, very important, when you're filling this form, do ensure you provide your correct TradingView username, because if the username is incorrect, it will not get activated for you. It will get activated to whoever that username belongs to. Now, if you don't have a TradingView account, you can click here and you can create a free TradingView account, because this indicator works perfectly fine even on a free TradingView account. It's not that it will only work on paid TradingView account. It works perfectly good even on a free TradingView account. So you can click here, you can create a free TradingView account. Once you have created your account, identify your TradingView username, input your TradingView username here. If you already have an account on TradingView, then you can click here to visit your profile. Again, identify your correct TradingView username and input that TradingView username in this column. And then you'll also get to know on which date this trial will expire for you. How did you hear about us? Just choose the relevant option. Click on I'm not a robot and click on finish and start free trial. And once you fill this form within 24 hours, the trial will get activated for you. And once it has been activated, you will get a notification on TradingView itself that now you have access to the indicator, and then you can try it for free for 7 days. Right. So since everyone has that opportunity that now you can try out the indicator 100% free for 7 days. So whatever analysis we will be doing will be based on the indicator, because that will help you see the beauty of the indicator and understand how it makes our life much more easier by automating the process of identifying the zones and even the process of multiple time frame analysis. So what we need to do now is go to the lower time frame. So let's assume this was the symbol which was shortlisted for us, and you can see it is identifying and plotting all the demand supply areas for us. Now, if I start from the most recent demand area, which is closest to the current market price, you can see it is this one, which is a drop-based rally. But what will happen is that as you start applying the rules of pivot and non-authenticity, I'm pretty sure this one will get rejected. This one will not qualify for us. So that is the reason I'm simply skipping it, because we understand this will skip based on the pivot and non-authenticity. A very simple quickly reason why it will get disqualified for us is, see, when we see structures of pivot and non-authentic zones, we look for certain conditions, right? Those conditions is either I should be having a violation of an opposing zone. Can you see it has not yet violated a zone on the lower time frame? So we understand on the intermediate time frame, nothing will be violated. And second is we need an impulsive move. You don't even have an impulsive move on the lower time frame. So how can you have an impulsive move on the intermediate time frame? So just by understanding that, we know that this will get disqualified for us. So we know since this will get disqualified, let's move on to the next area of demand. The next area of demand is right here, which is the rally-based rally. So let's draw this demand zone. All right, so my step number 3 was to identify a zone on the lower time frame. We have identified the zone. So my step 3, identify zone, is complete. Do we have a zone available? The answer is yes. So now that we know we have a zone available, we can't trade these zones blindly. We'll have to qualify them, which is a 2-step process. In step 1, we'll qualify them based on certain conditions, and in step 2, we'll qualify them based on the booster scoring. So the first condition is, can the zone be a case of level on top of level? Now, how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside my intermediate, which we call as a coinciding level. So if you have a coinciding level, there is a possibility it might be a case of level on top of level. But if you don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with an intermediate time frame zone? And you can see wherever my lower time frame zone is, there is no intermediate time frame zone available. The intermediate time frame zone is a little lower. So yes, talking about a coinciding level, this is not a coinciding level. And since this is not a coinciding level, this cannot be a case of level on top of level. So again, level on top of level not applicable. If you talk about gap, then you can see we definitely have a gap up from here. You can see we moved up, we paused, and then we gapped up from here. So this is my closing price and this is my opening. So we do have a gap, and that gap is still an open gap. So now if you talk about the gap, we do have a gap. And if we move on to the rule book to understand the rules of the gap, there it is. Can you see, using gap as a demand zone or a supply zone, first thing is it has to be an overnight gap and an open gap. So we just saw that I'm on the daily time frame. So by default, this is an overnight gap, and we also have an open gap. We have also verified that. Now, the next thing it says is we only use pro gap, and it has to be identified using the daily chart. So here you can see, if you want to go for the definition, the dominant direction is prices have been moving up and then we got a gap up. So technically, if you talk about this gap will be termed as a novice gap. Why? Because this is in the direction of the price, right? Whatever the dominant direction was in the recent past, we have been moving up and then we got a gap up. So if we just go with the definition of the gap based on the second rule, which is we only use pro gaps, this zone will get disqualified for us. But you need to understand that in a stock that is making all-time highs or all-time lows, we need to be aggressive for the fills. Therefore, you can even use a novice gap. So this is the rule I was talking about, that we are for the very first time in the last 2 years looking at such an example. Because if I go to the monthly chart, you can see this is a symbol which is making all-time highs. And in a symbol which is making all-time highs, you don't know how long it will just keep making new highs. So if you are waiting for prices to retrace back to a zone which is a novice gap, you might never get an opportunity, or you might have to wait for a very long period of time to get an opportunity. Now, if I just show you as an example, can you see when prices were making all-time highs sometime back in the month of July? You can see sometime in the month of July, that is also where you gapped up. You can see this was my closing price and this was my opening price. We gapped up, and that given point of time, yes, we would have again called it as a novice gap. But what happened? Prices came back into this novice gap, yes, tested it multiple number of times, and that is where this next leg of the up move started. So this is why you need to remember that in a symbol making all-time highs, if I'm saying, okay, I don't want to use a novice gap, I will only be waiting for a pro gap. That pro gap might be really, really far away. You might not get those deep corrections, which can make you miss a lot of opportunities. So yes, even though this is a novice gap, because the symbol is making all-time highs, our rule book tells us that yes, we can use even a novice gap to plan a long trade if you want to be a little on the aggressive side. So yes, it is a novice gap, but definitely qualified for us. not a structure, a pivot, or no authentic zone, not even unstable equilibrium. So after applying all the applicable rules, is it qualified? The answer is yes. So now that we know we have a qualified zone, does not mean we'll blindly trade it. The next step is we'll understand its quality and probability factor by applying the boosters. So let's go to the booster sheet and let's start applying the boosters. And before we do that, let me also mark my areas. So booster sheet. So the first one is freshness. The zone is definitely fresh, gets a score of 3. If you talk about the strength, even if you forget the gap for a minute, you can see the move is an explosive move. That is the reason the indicator is marking for us. But yes, being a gap, by default, it is a score of 2. Time at the zone, we only have 2 candles, gets a score of 2. Reward to risk ratio will take as an assumption because nobody knows how the arrival would be. And the RR can change based on the arrival. So that is why before entering the trade, we always verify, do we still have the minimum required RR for us? Now, talking about the location, this is a symbol which is making all-time highs. But what we can see is that my zone is already located in the demand zone on the of the higher time frame. So we can see that yes, we are already planning our trade at the best location, which gets a score of best location, which gets a score of 2. Now at best location, trends, they definitely become irrelevant. Doesn't matter whether we are in an uptrend, downtrend, or sideways. But otherwise, if you go to the intermediate time frame, you can see the indicator is telling us we are in an uptrend because we have had violation of 2 supply zones, one after another. And if supplies are getting violated, all that could mean to us is that prices are making new highs, which implies that we are in an uptrend, gets a score of 1. Now, talking about move from the zone, we need a minimum of 4:1. We already have a move which is much bigger than that, which again gets a score of 2. It is not a case of level on top of level. We have already verified that. Not even a coinciding level. We have also verified that. Talking about trap, I might be able to give it a score of 1, but let's verify that because I can see we do have this area. If I push it to wherever the proximal is. So, and if I start pushing it a little up higher, you can see almost this area has acted like resistance in the past and once acted like support as well, right? Yes, definitely I would like to see multiple tests. So if just based on this one test, if you want to call it as an area of support and resistance, that's your choice. I'll say you're being a little aggressive. Ideally, I would like to see multiple tests. And if you read majority of the books which are on conventional technical analysis, they always say that you should be able to see at least 3 tests. So based on that, I would say it's not something which everyone might be looking into as a strong area of support and resistance. So I'll prefer to give it a score of 0, not a score of 1. And if you look at the overall scoring, we have a high quality zone and a high probability setup. So a high quality, high probability setup, can you see? We just got an alert. So that is what alerts they do. As soon as you have formation of zones, you just keep getting these updates. Anyway, so coming back to this, a high quality, high probability setup can be traded as a type 1 trade. So this is qualified as a type 1 trade for us. So what do we do next? We do our proper position size calculation because irrespective how high the quality or the probability is, any trade can be a stopped out trade, right? It can be a trade with a score of 10 out of 10 and 8 out of 8. Still, it can be a stopped out trade. So you need to remember that the scoring is not for surety. The scoring is for probability. So yes, this is high probability, but it can still be a stopped out trade. So that is the reason we need to be ready for the worst case scenario. We'll do our proper position size calculation. Wherever the prices are coming back to the zone, we will quickly re-verify the way we just qualified as of now. That does it still match with my trade plan? If the answer is yes, it is qualified. You place your order based on the entry type. In this case, it is a type 1 trade. And once your trade has been executed, the last step is your trade management, where step 1 is at 1:1, we make it as a break-even trade. And after that, if you get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades in a very mechanical and rule-based way. And if these sessions are helping you plan better trades, then do like the video. If you have any feedback, if you have any comments, you can definitely put it in the comment section. And the most important part, if you have any friends or family members who are into trading, or if you are part of some trading group or trading community, my courses are 100% free. These live sessions are 100% free. So you can spread the word. You can share my course content. You can share the link to these videos. in those groups, in those communities, so that more and more people can take advantage of it. And yes, since we also offer the demand and supply zone indicator 100% free trial, you can even share that so that more people can take advantage of it. They can try it out, and if they feel okay, the methodology is helpful to them or the indicator is helpful to them, and it is helping them plan better trades, why not to spread the word in the community? All right, now one thing which I'll add before I take the questions queries at the end of the session, that is that I constantly get this feedback that yes, at the end of the session you do take the questions and queries, but in those questions queries, what if I don't want to ask publicly, I want to ask it in a private setup? Or what if I want to share my analysis, which is not possible in the YouTube chat? So we do have an option which is called as a one-to-one appointment. So when you visit our website, on the top right corner, you can see you have this option which says one-to-one. You can click on it, and from here you can schedule a one-to-one appointment with me. Now there are two different appointments available. One is a voice call. So if you feel that on a telephonic conversation, on a voice call, you can ask your questions, queries, get your answers to those challenges, yes, you can go for a voice call. If you feel you want to share your analysis, for which you want to go for an online meeting, that option is also available. So yes, in case you want a one-to-one session, you can always book an appointment from this link. But otherwise, if you have any questions, queries, which you are comfortable sharing during the YouTube live session, you can always put your questions, queries in the chat box, and I'll try to answer all the questions that I get before we end the session. So let's see, what do we have in the chat box today before we end the session? I'm struggling with the indicator settings. What is the auto settings section all about? Can you explain? Okay. See, the auto settings is basically designed for someone who has a free TradingView account. Now, why for someone who has a free TradingView account? So let's assume this option was not there. Let's assume for a minute this option was not there. So what would happen now is, once I'm on the lower time frame, I've done my analysis, right? Now, the next thing I need to do is, on the intermediate time frame, I need to do my zone violation analysis. Can you see when I go to the intermediate time frame, it is not doing automatically. So what I'll have to do is, I'll have to check mark I want all demand supply structures, and then I'll have to check mark show me zone violations, and now it is telling me that I am in an uptrend because we have violation of two supply areas. But now again, if I go back to my daily chart, it is still doing exactly the same thing. It is still now identifying all the zones, and it is still doing zone violation analysis, which is not required on this time frame. So what I'll have to do now is, once I come to this time frame, I'll have to disable this, that I don't need all structures, I don't need zone violation analysis. Similarly, once I go to my higher time frame for the curve analysis, I'll again have to enable this, all zones. I'll have to enable curve analysis so that my curve analysis is done. But now if I go back to weekly, right, it is still using all zones. If I go back to daily, it is still using all zones and even doing curve analysis, which is not required on this time frame. So what is happening is that once I enable a setting, that settings remains enabled unless and until I manually remove this. So what happens is, for a person who has a free account, they will have to switch between these settings manually over and over again. So to avoid this manually enabling and disabling over and over again, we have given this option for automatic settings, that when I go to the higher time frame, it will automatically do the curve analysis for me, and for curve analysis it will use all zones. Whether you want to use fresh, whether you want to use tested, that's your choice. When I go to my intermediate time frame, it will use all zones, and on intermediate by default it has to do the zone violation analysis for me. It will do for me. And similarly, if I go to the refining time frame, it will automatically enable all zones. So these things which we manually had to enable and disable now has been automated. So what is happening now is, can you see when I go to the weekly, it is automatically doing the zone violation analysis for me. But coming back to daily, it is not doing it anymore. If I go to the monthly, it is automatically doing the curve analysis for me, but going back to daily, that curve analysis is no longer enabled. So that is what this is for, that somebody who has a free TradingView account, because you cannot have different chart layout, you can only have a single chart layout, and you will have to use that single chart for everything. The process gets automated for you instead of you doing it manually every time you're changing the time frame, right? So that's the idea behind this particular option. So I hope that helps you understand why we use this particular feature. All right, so what chart it is? So again, I have talked about this many times. The idea behind these sessions is not to give you ready-made trades. So that is why the name of the symbols, the pricing are purposely hidden because we are not providing you ready-made calls or tips. We are helping you understand how to do the analysis. And once you learn how to do the analysis, you can do it on any charts. So that is why we do not disclose the name of the symbols. We only help you understand how the analysis has to be done. And yes, that's how these sessions are designed. How do you scan for trades in different stocks in different time frames? See, I personally use my scanner, right? So based on the scanner I shortlist, I ask the scanner to identify symbols where I'm getting closer to demand and supply areas. And once that is shortlisted for me, then I manually go through all those symbols and see which one I'm interested in and which ones they do not match with my trade plan. So I do it based on the scanner, but we have two tools available. We talked about those tools during the session, the alerts and the screener. You can decide which one is more beneficial to you, and based on that, you can always shortlist your symbols. Is this indicator inspired from Sher Khan? I have no idea about Sher Khan TZI. I've never used that indicator. This is based on I'll say I have been doing demand and supply trading since 2009, right? So since 2009 till today, whatever experience I have gained from demand supply methodology. So based on my experience, I have created this indicator, and again, it has been coded by me, not by anyone else. So that is why I have a lot of faith in the indicator, because it is exactly what I am looking for, because it has been coded by me. All right. If in intermediate time frame, one strong zone, but when I check the location, then it is tested, then it shows low on the curve. But if I select it as fresh, then it shows high on curve. So in this situation, what can we do? See, again, the first thing is you have to decide whether you want to use fresh zones for your curve analysis or you want to use tested zones for your analysis. Because definitely if you're using fresh zones and tested zones, the curve will change. Now, a very simple example, because I am planning MIT trades, and I know as an MIT trade, my higher time frame will be monthly, and the bigger the time frame, the higher the weightage. So this is why I don't mind using tested zones when I'm doing my curve analysis. But if I was planning an HIT trade, I know as an HIT trader, I'm using very small time frames. So I need to have that extra probability where I will only be using fresh areas. So it is part of your trade plan that whether I want to use fresh areas, whether I want to use tested areas. As a conservative trader, you might always want to use fresh zones. As an aggressive trader, you might be comfortable using tested zones. And again, based on the time frame you are trading, you might be comfortable using fresh, you might be comfortable using tested. So that is something you have to figure out, but you can't do, okay, let me plan MIT trade. In one MIT trade, I'm using fresh. In the other one, I'll use tested. That is wrong, right? So define what is your trade plan. If your trade plan says I always want to use fresh, then always use fresh. If your trade plan says I always want to use tested, then always use tested, right? That is how it has to be done. All right. So demand and supply zone indicator, does it work well for intraday Nifty option trading for scalping? See, again, the job of the indicator is not to give you buy-sell signals. If you're talking about does it work well in identifying the zones, my answer is absolutely. In identifying the zones, it works perfectly. But you cannot blindly use any demand area or any supply area. Like in this example, we had a demand zone, but I said this one I'll not be interested in. I'll be interested in this demand area, right? So again, the job of the indicator is to identify the zones. Will it identify the zones correctly? Absolutely yes. Which zone I need to use? That is part of your trade plan. And that is what I teach in these sessions, right? How to define your trade plan and based on that use those setups. Now, once the zone has been identified, you can use it as a trade for planning a trade in stocks. You can use it as a zone to plan trade in futures. You can use it as a zone to plan trade in options. But remember, for the options, we do not mark the zones on the options premium chart. They are always marked on the underlying. But yes, once it has been qualified, whether you want to use that zone for stock trading, for future trading, for options trading, that's completely your choice. But the zone will still remain the same. Can I... Okay, since I'm a scalper, I use 3 minutes time frame. Any advice how to use the demand supply zone indicator efficiently? See, again, like you said, you use it on a 3 minutes time frame, right? So let's assume I want to define my time frames now. So the 3 minute will become as your lower time frame, LTF. Then you need to have your intermediate time frame. Then you have to have your HTF, right? And I have talked about this in the past as well, that whenever we talk about multiple time frame analysis, whenever you're going from one time frame to another, it can be a multiple of 3 times to a maximum a multiple of 6 times. So what I can do is, if this is my 3, I can use my intermediate time frame maybe as a 10 minutes chart, because 3 3s are 9, so we are a little over it. Even if you want to use 15, you can also do that, because 3 5s are 15. That can be your intermediate time frame. And then for your high time frame, maybe even if you want to go for 3 times, you can use a 30 minutes chart, right? If you want to go 3 times, in fact 4 times here, you can even use a 60 minutes chart. So now you have defined your lower time frame, you have defined your intermediate time frame, you have defined your higher time frame. Based on that, do the analysis. If a setup is qualified for you, yes, maybe you can use it as an opportunity. But again, it has to be qualified to be used as an opportunity, not just because we have a zone on the chart. All right. So do we have to insert time frames into auto settings as mentioned? Absolutely. No, because if you do not define, how will the indicator know on which time frame I need to do curve analysis, on which time frame I need to do zone violation analysis? So you will have to define it here. Only then when you change to that particular time frame, it will do that particular analysis for you. All right, so please also include DIT, HIT trades. See, again, the thing is, I am not doing homework specifically for this session. Whatever I shortlist for me, based on that list, I share something with you during these sessions. And I only do 100% MIT trades. So since I only do 100% MIT trades, I only share opportunities based on that. I don't do any other kind of trading, HITs or WITs or DITs. So that is the reason you will see that whatever I'm sharing is basically MITs. But again, the process remains the same. Only the time frames will change. It's not that for a DIT trade you have to do something else. Only the time frames will change. Process remains exactly the same. All right, so Ravi, I will do that, but next time, because we are almost at 11:55 and 12 p.m., I have to do the Hindi session, so only I have 5 minutes left to switch to the Hindi session. So that is why I'll be cutting short today. So again, thank you everyone for joining in. I will be seeing you now next weekend. Till then, trade safe, enjoy your Sunday. Take care. Bye-bye.